Hello, everyone. Thanks for joining us today. My name is John Petrides. I'm a managing director and portfolio manager with Point View Wealth Management. We're going to give people a few seconds to join the webinar, and then we'll begin our sixth webinar, 5 Financial Must-Dos Before Year End. So let's give everybody a few minutes to join, and then we'll begin the show. All right, let's start. Like I said, my name is John Petrides. I'm a portfolio manager and managing director with Point View Wealth Management. Joining me today on the webinar is David Dietz, president, founder, and chief investment strategist of Point View, and Claire Toth, our chief operating officer and financial planner of Point View. This is the 6th webinar that we've hosted this year. We've had fantastic attendance and feedback on these webinars. So if this is your first one joining, please be on the lookout for at least 12 more webinars in 2019. And we enjoy your participation and feedback. A couple of housekeeping issues before we get into the webinar. This is the 5 financial must-dos before year end. You'll see on your webinar panel, there's a chat button. So please click on that and ask and answer any questions that you may have. We'll get to them at the end of this webinar. And also there's a poll that we ask you to click on and participate in. And the question is, which asset class do you think will be the best performer in 2019? Obviously, there's been a lot of volatility in the market, and the choices are stocks, bonds, cash, gold, Bitcoin, or real estate. So please put your answers in there, and we'll go back to that topic, and we'll give the results at the end of the webinar. Okay. So right now, I'd like to turn it over to David Dietz to begin the presentation.
Yes, thank you so much, John, and welcome all. Before we get into what you've got to do, or we want you to do, or you perhaps could do probably the next 11 and a half days here, just want to talk a little bit about how our firm and our mission is a little bit different from the competition down the street. We are, of course, based here in Summit, New Jersey. I started this firm nearly 26 years ago, and the underlying premise is that we are independent. We're not part of a large shop which has all sorts of products, that has people down the hall who are trying to curry favor with issuers of securities, and therefore we're conflicted when we try and advise our clients as to the merits of investing in them. We are fee only, which means we have the ultimate transparency in terms of compensation. We charge a flat fee on the accounts we manage. There are no sales commissions, back-end fees, front-end fees, hidden trips to the Bahamas, or anything like that. That's all we do is the fee-only management. We are registered with the SEC. Why is that important? Because in this day and age, fiduciary duty and adherence to higher standards of fiduciary duty is always what you should be seeking in an advisor. Why is that important? When you have to adhere to the highest fiduciary standards, you must put the client first. You always have to think what is in the best interest of the client, not what may work, which may be suitable, but still kind of lines the advisor's pocket. No, the lowest cost, the best product, period. That's what we're all about. Now, of course, we manage accounts here, but we're very conscious of the fact that one size does not fit all. So every account, every portfolio we manage is tailored, is customized to what works best for that particular client, which may be very different from the next client. We couple that with very much holistic financial planning. In some cases, it's more important to know whether you're using an IRA versus a Roth versus a 401k than getting into the nuances of the difference, for example, between Google and Amazon. Who are our clients? Primarily private clients. That would be individuals and families who are subject to tax, but we also are proud of the fact that we're working with a number of small institutions, endowments, and charities, and the whatnot. So the other way that we really part company from our competition down the street is that unlike most advisors, we actually buy stocks and bonds. We don't simply buy other people's portfolios like mutual funds and ETFs and put them in clients' accounts. We think that's so important because A, you sidestep another layer of fees. B, you can achieve the most tax efficiency because you start your own basis and you're in control, not a fund manager that you don't know of any potential turnover and triggering gains and losses. You always know what you own. There's not that non-transparency that comes from that fund wrapper. Our clients, we ask that they start with $500,000 or more. Our fees are very transparent. It's a flat 1%. But it's not just to manage people's accounts, but it's to provide 24/7 financial planning. And that can range from questions from, IRAs versus Roths, but estate planning questions, gifting questions, how to put your child or grandchild through college, the whole gamut. And of course, you sidestep the underlying fees of funds and ETFs that are used by other advisors. We have an alternative system here where you can just ask us to do the deep dive on all of your financial matters, come up with a chapter line versus game plan for your investment accounts and all other financial advice for a flat fee. Should you take the next step and have us manage those accounts, that flat fee is that works to offset dollar for dollar ongoing investment management fees. And finally, in this kind of post-scandal era, clients take comfort in the fact that all their assets are custodied at Fidelity Investments, which is one of the planet's most reputable, largest asset custodians in the world. They're not in Point View's name, they're in your name, which gives you the utmost control and security. So before, again, we get into the meats and potatoes, just want to point out how proud we are of some of the recognition we've gotten. CNBC the other year ranked us number 5 in the country among independent fee-only registered investment advisors. And just this year, we were proud to be recognized by Financial Advisor magazine as one of the top registered investment advisors in the USA. So, John, Claire, and I work together here, but we are supported by a whole cast of characters that we're very lucky to have working with us. We have 2 other portfolio managers in addition to John. That would be on the right would be Elaine Phipps and Donna St. Amant. And then, of course, we've got Jeanette Carey, just to my right in the picture, and just beyond her, Annette Tucker. And then we've got below Annette and Jeanette would be Chris Gilmartin, and finally Marcela Garcia. So here's one thing that you really should be looking to do in the next 11 and a half days. If you've been successful in your investing, you can't take the money out without paying capital gains tax if you have a long-term gain, or short-term capital gains tax if you have a short-term gain. And so if you have an unbundled portfolio or just a whole series of funds, you may have some winners and you may have some losers. What you're trying to do at the end of the year is to prevent having any gains that you're going to have to pay Uncle Sam and your state tax coffers any tax on. So ideally what you want to do is offset any gains. And even going beyond that, if you end up with $3,000 of losses, those $3,000 of net loss can actually be used to offset ordinary income, for example, dividends, interest, or salary from employment. Many people say, well, if I didn't do anything, I probably don't have any capital gains. Well, that's not necessarily true. Let me give you some examples where you could have some gains even though you stayed the course. If you own mutual funds, they continue to turn over the position, their portfolio, and then at the end of the year, they distribute to all the holders of the funds their pro rata share of the gain. So even though you held tight on the fund because internally positions turned over at a gain, they could be distributing to you gains, and so that you have to deal with those. Alternatively, if you have a stock portfolio, even though you tried to stay the course, occasionally one of your holdings is bought out. The good news is that's often at a profit. The bad news is that can trigger a realized capital gain that you have to deal with. So what we like to do is tally at this point in the year, what are the net capital gains that we may have to pay tax on, and then scour the portfolio to see if there's any losses that we could, in other words, sell the position, realize the loss, use that loss to offset the gain, and pay less to the tax people at the end of the year. We show you on the slide some of the examples of transactions that occurred in this year which were involuntary. And so, for example, if you own Time Warner, you had a profit, AT&T bought it out, now you've triggered a large capital gain in your shares of Time Warner. Now, some people say, well, I don't have any gains, so I just start selling losers and tally up a whole bunch of losses. Not necessarily. And here's why. Because, look, if you don't need the losses, why stockpile them? What can happen is in 2019, one of two things can happen. The loss stays a loss, the stock doesn't move up, well, then it's available in the next year to take. Or it moves up in value, and quite frankly, if you do the math, a loser moving to a winner is worth more to you on the bottom line than the value of triggering the loss the prior year. So,
and let me also jump in for
Yep.
those of you who are in New Jersey. There is no concept of a loss carry forward in New Jersey. If you have a loss for the year, all you can do is zero out your capital gains. You don't get to take them forward to the next year. So the federal taxes are the 800-pound gorilla in the room, but be aware that the state tax treatment can be different.
Yeah, and so, Claire, that's a great point. And one more reason not to stockpile losses you don't need, because at least for state purposes, those losses can't be carried forward to the next year. So now here is our next tip that you really should be doing before the end of the year, which is to take some of your employment income and max out what you can put into your employer's retirement account, typically called a 401k. It could be called a 403b. This year, the maximum you can contribute to one of those programs is $18,500. It moves up to $19,000 next year, and if you're a senior citizen, 50 or up, you can actually put in another $6,000. Now, why is that such a good idea? Well, every dollar you put into one of those programs actually is going to cost you less than $1. Now, why is that? Because that is deductible from the current year's tax. So that if you're paying New Jersey, as an example, and federal tax of, let's say, 30%, 35%, let's say it's 30%, you put $1 in, it's only going to cost you 70 cents because you're going to pay 30 cents less to the government as taxes. And then, of course, once it's in there, why is that such a good thing? Any future profits that build up during that are tax sheltered. There's no current taxation of any profits. Now, of course, in a traditional employer retirement program or IRA, when you take that money out, it will be taxable. But, you know, Financial Planning 101 is to defer a bill if at all possible and pay it later rather than earlier, because you, in effect, have that interest-free loan from the government. And so that's a very good thing. And finally, it enhances our discipline. You know, one of the secrets to successful planning for retirement is not just to have great whiz-bang investment returns, but to save money in the first place so that you can invest it. Of course, once you save it, you have to keep it saved. And what we like is that these retirement programs like a 401k or an IRA, they act like a virtual piggy bank, because once the money goes in, because of potential penalties for early withdrawal and taxes for a permitted withdrawal, you're less likely to take it out for a frivolous reason, but rather let that stay in there and marinate, as it were, until you really truly need it. So then finally, after your employment contributions, take a look at contributing to your IRA. Anyone who's 50 and over can contribute $6,500. If you're under 50, it's $5,500, and both of those numbers are going to go up by $500 next year. You actually have till the time of filing of your tax return to make those IRA contributions. So in fairness, it's not quite
excuse
before
me.
year end. Go ahead, Claire.
Sorry about that. Let me clarify. You have until April 15th to make an IRA contribution, whether or not your tax return is out on extension.
Yep.
But
Awesome.
certainly, if you don't have the dollars lying around now, you should commit to making this year's IRA contribution by April 15th of next year.
Awesome. And so depending on the level of your income, you may and whether you're entitled to participate in an employer program, you may or may not get a deduction for that IRA contribution. That's a detail that we could certainly advise on. But the point is, again, you get it into a special fund and you're more likely to keep it there and let it grow over time. Finally, it's always worth considering whether you should be using a Roth. Roths are better than IRAs because if held for the requisite amount of time, first of all, there's no required distributions when you're 70 and a half, like with IRAs, and even better, with an IRA, whatever you take out is then subject to tax. With a Roth, everything comes out tax-free. So that's better. But there are strict income limitations as to whether you're permitted to open a Roth. We can advise on that. It's complicated depending on your filing status and so forth and your overall income. However, if possible, do initiate the Roth. And finally, health savings account. They're like IRAs, but or Roths actually, but are dedicated for your health spending needs. And again, those are very much worth contributing to now. Rebalancing your portfolio. What does that mean? Basically, we urge all of our clients and all investors should have a plan for their investments. What do I mean by a plan? Well, after thinking about what you're trying to do and the ride you're willing to take to get there, you want to divide your portfolio. We start with like three main food groups, three main asset classes. That would be stocks, bonds, and cash. So you divide that, you assign a percentage of your portfolio to each of those classes. It could be, let's say, 60% equities, 35% bonds, 5% cash. And then over time, with market fluctuation, your portfolio may start to deviate in terms of percentage allocation to each of those three main asset classes. Then what you should do, in our view, is rebalance. So what does that mean? If equities have gone from 60 to 65% and bonds from 35 to 30, sell 5% of your equities and move that to bonds. Now, why is that such a astute thing to do? Because what you're doing is you're selling from the outperforming and therefore likely to be more expensive or less attractive asset class, in that example, equities, and moving into the laggard, more defensive class, in other words, bonds, and that helps you reduce risk and also add to the laggard. And historically, there are leaders and laggards, but they keep switching over time, so it forces you to keep moving the money back into what seems to be underperforming, therefore undervalued. And so with the same amount of risk, you should be outperforming. We like to keep rebalancing back to percentages. So it's not a question of saying, well, it seems like stocks have done better, bonds have been worse, but you can calculate it precisely. You have a percentage that is that is assigned to each of those asset classes. You look at where you now are and move it back to those percentages. And of course, that can be done at the sector level. Sectors, what are sectors? Energy, financial services, healthcare, technology, and you can also do it on stocks. So that, let's say, each of your stocks might be a 2% allocation portfolio. If one all of a sudden is doubled or tripled, it's like an overgrown weed. It's obviously outperformed. Congratulations, but now it could be overvalued. And certainly, if there's a hiccup there, any kind of retreat, because it's a larger position, is going to make your portfolio feel more pain. Rebalance, take some off the table there and put it into an underperforming sector or underperforming security. We think ultimately more return, less risk with that methodology. Claire?
Okay. You have another week and a half to reduce your tax bill by giving money to charity. Um, a month ago, 3 weeks ago or so, John and I did a webinar on this. The link is available on our website, so I'm not going to go into a great deal of detail here. If you are required to take distributions from your IRA, i.e. if you're 70 and a half or over, the ideal thing to do is to give that money directly to an operating charity. That takes the money off the top of your tax return and allows you to use all of your other deductions on top of that. If you're not eligible to do this from your IRA, you should bunch gifts. Give a whole lot of, give maybe 5 years worth of gifts in a single year, ideally to a charitable gift fund, so that you don't have all your favorite charities expecting that kind of gift every year from you. And do it with appreciated stock. That way you both avoid capital gains tax and get the maximum deduction possible. And again, I'm happy to address specific questions, but we talked about this in detail last month. So your final to-do is to take a look at your estate plan. We all hear about how tax law is changing, but a lot of other things have changed, and they've probably changed since the last time you had your documents. I see an awful lot of wills that name guardians for children who are now in their 20s and 30s. If your documents are more than 12 years old, chances are they don't have the right language that would allow your doctor to talk to family members if they needed to make medical decisions about you. And you'd really like them to know what your medical decision is before they make, or your medical condition is before they start making life or death decisions on your behalf. There have been recent changes involving electronic assets, the ability to access your computer, the ability to go online for bill pay, credit cards, social media. That all needs to be spelled out in your estate planning documents. We review a lot of estate planning documents for folks. Many practitioners I know will sit down with existing clients, see if things need to be updated or not. And if they charge for that, they'll apply it to the bill for amending the documents if it's needed. But this is certainly worthwhile. You also need to make sure that your beneficiaries on your retirement plans, IRAs, life insurance, and annuities match your estate plan overall. Those accounts, again, retirement accounts and IRAs, life insurance, annuities, those are not governed by what's in your will. They're governed by the beneficiary designation. And occasionally we hear horror stories about someone whose ex-spouse is still the life insurance beneficiary. The person dies, current spouse is left out in the cold, former spouse is a millionaire several times over. That's probably not the result that person wanted. If you are 70 and above, it's time to start talking about a living trust or a revocable trust. It's both a will alternative and a way for family members to help manage your assets should you need or want some assistance. And the point of all of this is that estate planning isn't just about taxes. It is not just about avoiding taxes. The taxes, as we know, at least in New Jersey, there's no longer an estate tax at all. Many other states have gone that route or have raised their taxable amounts. For federal purposes, a married couple needs to be worth about $23 million before there's an estate tax. So that's, for the most part, not what we're talking about. A lot of tax planning with estate planning now involves income taxes, and specifically the income tax bill you may be leaving your children and grandchildren. So that's a conversation worth having. And because the landscape is changing constantly, I like to see estate plans with a lot of flexibility in them, letting your family members make decisions when the decision needs to be made. That may be after your death, that may be some years after your death, rather than trying to control everything and micromanage now, so that it doesn't work under changed circumstances. But the bottom line is dig out that estate plan, dust it off, and sit down with your lawyer, your financial advisor, to see if it still makes sense for you. And I think it's over to John.
Thank you, David and Claire. Great job. Now, obviously, everyone, all of these topics require a lot more attention than a couple of bullet points on a slide. If you need help analyzing what your tax situation is to harvest losses, let us know. Claire touched on so many topics that can impact just about everybody from an estate planning issue. It may not be you that has the questions, but maybe it's a family member or a friend. Well, give us a call. We'd be happy to sit down with you. Here's all of our contact information. Here's the way to email the firm. Check out our website. We'd love to sit down with you. Obviously, it's a complimentary meeting. If you know someone that was unfortunately recently laid off or changed jobs, we'll help them. Don't let them leave their 401k behind. Roll that to your IRA. There's so many things that can be done, and we would be happy to help. So before we get on to the next part, we're just going to move to the Q&A. There's a chat button on the side. The Q&A, by the way, is private, so you can ask any question you want. We'll do the best as we can to get to it. No one else sees it, so don't feel embarrassed by the question you may ask. There are some coming in. So before we begin answering the questions, I just want to go to the poll and review that. So the question was, which asset class do you think will be the best performer in 2019? Interesting, what a difference a year makes. Not one person selected Bitcoin. Last year Bitcoin was all the rave. This year Bitcoin's down about 80%, and no one thinks Bitcoin will be will be the best asset class next year. Stocks were the leader with 33% of the vote. Bonds second at 25%. Cash at 8%. Gold got 17% of the vote, and real estate got 17% of the vote as well. Mm-hmm. So David, Claire, I'm going to field some of these questions that are coming in. Mm-hmm. Here's one. In a retirement plan, spousal consent is required if a person is married and wants to name someone else as their beneficiary.
That's correct. This goes back to 1982 when I began my legal career. Employer-sponsored retirement plans are set up. The default is that when you retire, you take your assets in the form of a joint and survivor annuity. It pays 100% of the annuity during your lifetime, and then after you pass away, your surviving spouse gets 50% of what you got. And because your spouse has that right under federal law with all employer retirement plans, your spouse has to sign off if you make another choice, whether that's a different beneficiary, a different payout formula. Many plans require the spouse to sign off when you leave your employer, if you roll your 401k out to an IRA. And it goes back to the federal law in 1982.
David, Claire, this goes back to David's slide and talk on harvesting losses. Someone has a bit more of a specific question. What is a wash sale? I hear a lot about it, but I'm not sure how it works. So as we're mentioning and recommending to harvest losses, you have to be careful that you do it in a way that the IRS doesn't make sure they acknowledge it appropriately. So maybe either of you can discuss about the wash sale rule.
Well, let me give an example. Say you have ABC stock sitting in your portfolio at a loss. If you sold it, you got to take a loss of $10,000. So you want to do that before the end of the year. On the other hand, you really like ABC stock and you'd like to hold on to it. So you sell it, take the loss of $10,000, and then turn around the next day and buy it back so you continue to hold it. What the tax rules say is you really haven't recognized that loss. because you're still holding on to the stock. And there's some very complicated rules about buying and selling a lost stock within 30 days at either end of the transaction, that expand to, you can't say buy it in your taxable account or sell it in your taxable account, buy it in your IRA, sell it in your spouse's account, buy it in your account, and on and on. Typically, if we like a stock, we tend to like that sort of industry group. If ABC company is, say, an energy stock, and we like energy stocks, we might sell ABC company at a loss and then turn around and buy XYZ company, so that the client still has the same exposure to energy, but because they're two different stocks, two different companies, it's not considered a wash sale. That's the 5-cent overview. There's a lot more beneath that we could go into detail it for a specific situation.
So basically, there is a science to harvesting losses. It's not just about just selling everything that's in red. You have to be careful of the timing of when you may buy that back to actually acknowledge the loss.
Correct.
David, maybe you want to take this one. Should I do a Roth conversion before year end? Now, there's a lot of variables behind this, right, in terms of household income and things like that. So why don't you start off on that one?
Yeah, absolutely, John. Thank you. So basically, as we discussed, having a Roth is much better than having a traditional IRA. There's no ultimately distribution schedule. You can sit on the Roth for the rest of your life, and any distributions that do come out tax-free. So the Roth is better. The problem is normally there's a cost associated with converting. What does converting mean? Taking money from your IRA, your traditional IRA, and putting it into the superior Roth IRA. And that typically is that you have to pay tax on any amounts you transfer from the traditional IRA to the Roth. I'll come back to that in a moment. So basically you're saying, gee, if I pay the tax now, am I going to be better off because I won't have to pay tax later? And there's a lot of different calculations there. What is your tax rate now versus what your tax rate may be down the road? And that, of course, will depend on a couple things. One is what your income is, but it can also depend on what state you live in and how the tax laws at that point work in this country in terms of the amount. Going back to the conversion, basically you pay tax on the amount you transfer, but that tax could be reduced to the extent you've made some non-deductible contributions into the IRA. It gets a little complicated. For most people, consider that any amount you transfer is going to be subject to current tax. The other aspect, of course, it may, on that conversion, that amount that you transfer, of course, added to all your other income for 2018, it could push you up into a higher tax bracket. That's not a good thing, but that must be factored into the calculation. So the bottom line is it depends. You want to work carefully with your tax advisor to make the right decision.
Mm-hmm. Great.
And let me just throw in that up until this year, taxpayers had a chance to do a do-over if they found they converted too much to a Roth IRA and it did bump them up to a new tax bracket, or if they put money into a Roth and whatever they invested in promptly tanked, they had the opportunity to undo that in the following year. That opportunity no longer exists. Mm-hmm. So if you're going to make a Roth conversion for 2018 or after, you're committed to it.
Claire,
yes.
Question for you. Mm-hmm. Like last year, do you foresee any changes to the tax law entering 2019? This time last year, mm-hmm. We were fielding a ton of phone calls trying to advise clients on, prepaying property taxes, right? Especially if you live in New Jersey, New York, or California. Mm-hmm. Anything funky going on right now that you would want to help out with?
Well, certainly just before Election Day, President Trump had talked about there was going to be a 10% middle class tax cut coming before the end of the year. Congress is going to wind things up for the year on Friday, and nobody sees any possibility that that is going to happen. So individuals, not so much at the federal level. At the state level, and here I'm talking only about New Jersey. New Jersey has increased its property tax deduction for state income taxes this year from $10,000 to $15,000. So if you live in New Jersey and you were among those who prepaid your property taxes last year to get the federal deduction, make sure you've paid at least $15,000 in property taxes this year to get the state deduction. And you may want to do a bit of a prepayment for next year if you're close but not quite there.
This is great, everybody. We have more questions to come in. So if you have a question on mine, feel free to jump in. I'm going to bundle two of them together. And David, maybe you could take the first one. Claire, I'll pass the second one to you, or you can mingle it. The first one is, can PointView help me review my estate plan? Right. So explain how PointView acts in that. And then there's another question on the back of that. Rather than rewrite a will to specify gifts to charities or people, what is a simpler way to direct executor trustee heir to make specific gifts from an estate?
Okay.
So David, you want to take the first one maybe, or
I'm going to let Claire take.
Okay.
With clients, I'm always happy to sit down, look at the existing estate plan. I speak lawyerese, and I've gotten pretty good at translating it back into English. So I will often sit down and write a memo to a client that's suitable for the client to show his or her attorney, saying, here's what your documents say. Here's what perhaps you should consider now that time has passed or laws have changed or your facts on the ground have changed. With the idea that the client can take that to the attorney. The attorney certainly is going to want to do his or her own documents. That estate planners don't view themselves as what we used to call mere scriveners. And again, when the client gets the draft estate planning documents back, it's a lot of thick lawyerese. I'll go translate that back into English, make sure the client understands and that the client, that reflects the client's wishes. I think it's a good way for the client not to spend a lot of time and money being educated by the attorney when I'm already a sunk cost.
Right.
When it comes to making specific gifts, first off, I think gifts to charity ought to come out of your IRA. Because anything that comes out of a traditional IRA that you leave to any beneficiary, those dollars come out as typically as 100% ordinary income with a few exceptions. So it's nice to be an IRA beneficiary, but there's a tax bill associated with it. Charities don't pay income tax. So if you've got $1 million in stocks and bonds and $1 million in an IRA, and you want to leave $1 million to charity and $1 million to keep your kids, the best after-tax result for everybody is IRA to charity, taxable assets to your kids. You've got to be careful crafting the IRA beneficiary designation to charity, because you don't. There are classes of beneficiaries you don't want to mix together, and that's a whole involved topic I can discuss offline with the person asking the question. When it comes to gifts to human beings, the two ways to avoid doing it in a will are A, have a living trust. It's easier to amend a living trust than it is to amend a will. And B, make the gifts during your lifetime if that makes sense with your overall wealth situation. And you're there for your children to be grateful to you for having made the gift.
Well, let me add one more. Another question came in. Mm-hmm. For a qualified charitable distribution from an IRA, must the person reach age 70 and a half before the contribution is made, or can the contribution be made in the tax year the person reaches 70 and a half?
The latter. You have to be 70 and a half by the end of the year.
Okay.
And let me add, it has to be from your IRA. So if you are 70 and a half and the only IRA you account in your name is the IRA you inherited from your sister, that's not considered your IRA. That's your sister's IRA. So it has to be the IRA that is based on your earnings and or your spouse's earnings.
Last question here. Are there, and this could go for both of you, are there general categories of stocks that don't pay qualified dividends, which are taxed at lower rates?
Yeah, I'll start this one, and then Claire will provide nuances. Basically, dividends are either qualified or non-qualified. In all cases, if it's qualified, it's going to be taxed at a lower rate. Qualified is good, non-qualified is the higher ordinary income tax rates. In some cases they're the same, but generally the qualified is going to be cheaper. So when would a dividend not be qualified? It really has to fit two main criteria to be qualified. One, it has to be paid out by a U.S. entity. So that's either a U.S. corporation or a foreign corporation that trades on a U.S. exchange. That's category one. Criteria one. Criteria two is it must be paid out by a corporation. So what could you buy out there that's not a corporation? The main entities that aren't corporations would be your REITs. Remember what a REIT stands for: Real Estate Income Trust. They are pass-through entities. You're not going to get qualified dividend treatment, but it would also apply to limited partnerships. So often in the oil and gas field, master limited partnerships, what they're paying out are not qualified dividends. Claire, anything you want to add to that?
You covered it.
Awesome. Well, I'm not seeing any more additional questions. David, Claire, thank you for your time. Thank you, everyone, for joining us. We're going to be sending out a replay of this over the next couple of days. And if we don't speak from you beforehand or hear from you, then happy holidays and happy new year to everyone. Thank you again for joining us, and be on the lookout for our next webinar in the new year. Take care, everyone. So long.